Hello, what's up, everybody? This is Sunko, the Korean bro. Today is 2022, November 17. Time flies indeed, and we have only 1 month left before the year turns to 2023, and I'll be 35 next year. But what we have to do today is what we've been doing this past year. So let's look at economic calendar first, okay? Mm. First, on 17 today, we have a lot of events. CPI from Eurozone, building permits from United States, initial jobless claims, Philadelphia Fed Manufacturing Index. Those are the four important events that occurred on 17th. And what I want to look at is initial jobless claims. Okay. What does that indicate? 222K. Actual points is lower than a forecasted point. And what does that indicate? Let's see. U.S. weekly jobless claims fall to 222,000. Jobless claims fall. Jobless claims fall, which means we can expect to have a better economic condition in the future, right? Okay, the number of Americans filing for unemployment insurance fell by more than expected last week, according to Labor Department data on Thursday. Seasonally adjusted initial jobless claims in the United States dropped to 222,000 during the week ending on November 12th, down from an upwardly revised reading of 226,000 and below economic estimate of 225,000. The 4-week moving average, which aims to account for volatility in numbers, grew to 221,000 from last week's level of 219,000. Scotty, okay. Initial jobless claims fall. Okay. Anyway, it's really good, right? Jobless claims fell, which means a lot more people work, right? So it's a good thing. And what else do we have? Philadelphia Fed Manufacturing Index building permits. What does that indicate? Building permits. Measures to change the number of new building permits issued by the government. Buildings permits are a key indicator of demand in the housing market. Demand in the housing market. Okay. So what does that indicate? It doesn't really. We don't have articles related to it. We have a Philadelphia Fed Manufacturing Index. It doesn't really much say about it. Okay, let's read this article. U.S. stocks are seen opening lower Thursday, with investors set to digest more corporate earnings, weekly jobless claims, and a plethora of Federal Reserve speakers. Not much about the results. Okay, let's go to Molly Fool. Okay, first. Did this one segment just save Nvidia investors? One monster opportunity arising in the global chip shortage. Here's exactly when Disney plans to become profitable. Now for stop buy, sell, or hold in 2023. Berkshire Hathaway just cut its stake in this long-time holdings by more than half. Two top Warren Buffett stocks to buy now and hold forever. The growth stock is a once in a generation buying opportunity in the bear market. One sensation stock with near 930% upside, according to our investment management. Kathy Wood went bargain shopping. Three stocks she bought hand over fist so far in November. One unstoppable Vanguard ETF that could double your money in 2023. Okay, this one Samanger saved Nvidia investors. Nvidia's gaming business has been hit hard by the current economic woes. However, its data center segment has proven to be remarkably resilient. Okay, so Nvidia have a data center, right? Data center. Hmm. Gaming business has been hit hard, okay, by the current economic woes. Nvidia is setting the stage for a remarkable comeback once the economy rebounds. Okay, they're ready for comeback. Okay, most of the semiconductor industry is deep in the red, but one segment is resilient. Okay, what is it? Consumers are reeling from the impact of inflation, which is hovering near 40-year highs, and interest rates are climbing with each passing month. Given that harsh reality, it isn't surprising that gamers are putting off big ticket purchases, which include upgrading to the latest and greatest graphic processing units from NVIDIA. Hmm. Which include upgrading to the latest and greatest graphic processing units from NVIDIA. Until recently, the gaming segment has historically represented roughly half of NVIDIA's sales. Since the beginning of this year, however, it has taken back seat to the data center business. Okay, originally NVIDIA's main profit came from a gaming industry, but now its profit has gone down, and instead, their main profit comes from a data center. Okay. Mm. Which represents sales of semiconductors and other gear used for cloud computing. Okay. Mm. Artificial intelligence data centers. When the company reported its latest results, this trend continued, helping save NVIDIA investors from what could have been a far more troubling fate. Okay. Okay. It's the economy. For NVIDIA's fiscal 2023 third quarter, the company generated revenue of $5.9 billion, which sank 17% year over year and 12% sequentially. The decline weighed heavily on NVIDIA's bottom line, as adjusted earnings per share of 0.58 fell 50% year over year. But the good news is that it actually improved 14% compared to second quarter. The biggest factor weighing on the results was gaming revenue. 51% year over year and 23% sequentially as demand for NVIDIA's high-end gaming processors slumped. CFO colleague Chris cited both macroeconomic headwinds and COVID-19 lockdowns in China for the heat to consumer demand. Okay. Another factor weighing on sales was a glut of processors previously used in cryptocurrency mining. The wide-ranging and ongoing crashing in cryptocurrency prices has made the process less profitable. Okay. There are a lot of factors. that has affected the revenue of Nvidia, and and listed ones are gaming revenue. So their gaming revenue has gone down, and uh things that got to do with cryptocurrency, because it's ongoing crash. There's an ongoing crash in cryptocurrency, so has made the process less profitable, forcing some miners out of business and flooding the market with their used NVIDIA processors. Okay. As a result of the aforementioned issues, NVIDIA is working its way through a surplus of current inventory as it prepares to release the next generation of its cutting edge GPUs. The launch is scheduled for next year. Okay. Cloudy skies. Okay. Robust growth in the data center segment helped counter weakness in the gaming segment. Robust growth in the data center. Yeah. Revenue grew 31% year over year with broad-based demand across cloud computing and consumer internet companies. There were challenges, however. In early September, the U.S. government levied new restrictions on the sales of high-end processors to China, specifically those used for AI, high-performing computing data centers. True to form, NVIDIA's engineers got right toward redesigning its processors to fall within the guidelines of the new regulatory restrictions, thereby minimizing the damage. The company has already started shipping the revamped processors to Chinese customers. Okay, they have like a collaboration with Microsoft. Okay, this will deploy tens of thousands of NVIDIA processors to help enterprise level businesses train, deploy, and scale AI, including state of the art models, through Microsoft Azure, the company's cloud computing platform. NVIDIA also linked a deal with Oracle to bring NVIDIA's full accelerating computing stacks to Oracle Cloud. This will deploy tens of thousands of additional processors and accelerators. For the upcoming fourth quarter, NVIDIA forecasts an uptick in sales, guiding for revenue of roughly $6 billion, which is comparable to Wall Street's expectation of $6.1 billion. Okay. Just so you know, after reading all of the articles that I just picked, I'm going to search the questions that I've been really curious about, which are, how do you know uh, that the stock that you just picked is cheap? And the second question is, how do you know when to sell? Those are the main questions that I've been thinking about. So after reading all of the articles, I'll be looking at it. Okay. One monster opportunity arises in the global chip shortage. Over the last decade, Texas Instruments' total return on stock was nearly 700%. The auto industrial market now make up nearly two-thirds. The auto industrial markets now make up nearly two-thirds of Texas Instruments' revenue. Okay. The company is building out several new chip manufacturing sites in the US to capture the growth expected over the next decade. Texas Instruments is just beginning to benefit from the savvy investment decisions they made a decade ago. It's by no means the most exciting semiconductor company, but in tough times, boring can be a good thing. Texas Instruments was a standout performer during the global chip shortage over the last couple of years. was a standout performer during the global chip shortage over the last couple of years. Over the last decade, its total return, which includes dividend paid, was nearly 700% as it benefited from a stock surge in 2020 and 2021. A decade ago, this industrial technologist laid the groundwork for its leading position in automotive and industrial computing. Now the chip shortage is beginning to ease, and TI's stock price has fallen in 2022 along with the rest of the semiconductor sector. However, with another decade of booming demand expected from its leading markets, this is a monster stock opportunity to take advantage of right now. Let's look at the price value of Texas Instruments. Okay. Mm, mm. Anyway, let's just keep because Texas Instrument. I don't know much about Texas Instrument. I know that it's got potential and that it's beginning to have a really good sales stuff like that, but I don't really feel it. Okay, so Netflix stopped buy sell hold in 2000 after losing customers in the first 6 months of the year. Netflix is back to position posting subscriber gains. A new ad-based tier should have a meaningful positive impact on Netflix's business starting next year. Netflix's current valuation looks appealing, considering where the stock has usually traded. Adding subscribers again. In the third quarter, Netflix resumed its trend of bringing on new customers to the platform after losing members in quarter first and quarter second earlier this year. For the quarter that ended September 30, the business added 2.4 million net new members, bringing the total to a staggering 123.1 million. The fastest growing market continues to be the Asia Pacific region, which added over 1.4 million new subscribers in the quarter. So their new subscribers came from Asian countries. Okay, current valuation. Okay. After Netflix stock got hammered this year, shares are now trading at a price to earnings ratio of 27, which is significantly lower than the trailing 5 and 10 years averages. The argument can certainly be made that the Netflix of the next decade won't achieve the outstanding gains that Netflix of the past decade did. When it seemed like annual revenue growth of 20% to 30% happened like clockwork. But the current valuation definitely looks attractive in the grand scheme of things. Netflix remains the top dog uh, in what has now become an extremely crowded streaming industry, with rivals all investing aggressively and competing for viewers' finite attention. Thanks to the company's first mover advantage, Netflix benefits tremendously from a massive scale and a huge content budget. They always need to continue releasing hit shows and movies. This should help Netflix maintain its lead in the years ahead. because they were like a first mover. They got a lot of advantage. Like since they are first mover, they got a lot of investment. They have a lot of money, so that they can release new movies and hit shows, right? And that helped Netflix maintain its lead in the years ahead. So the business has faced its fair share of criticism this year, and as a result, the pessimism surrounding Netflix prospects hasn't been this high in a long time. For investors who can look past the company's recent struggles and adopt a long-term mindset, Netflix stock could be a smart buy for the coming year and beyond. Hmm. Recently, they shared a lot of criticism, so the price level went down. But then, if you're a long-term investor, it's worth buying that because they are like first mover. Since they are first mover, they got a lot of money to invest, so they can maintain its lead in this industry. Um, Everybody knows that the streaming industry is competition here is really fierce, but then um, they release hit shows and movies over and over, so that's what makes them have a maintained lead. Hmm. Anyway, next one, Warren Buffett just bought this absurdly cheap stock. Should you buy? Hmm. No. Next one, Shopify. Okay, let's read this. Once in a generation buying opportunity in the bear market. Shopify. Let's read this aloud and let's try to understand this in depth because this is what I spend money into. So Shopify stock is falling sharply in response to temporary headwinds, but the long-term investment thesis remains solid. Shopify is the market leader in um, e-commerce software, and its ambitious growth strategy should further differentiate it from the competition. Ambitious growth strategy. Okay, what ambitious growth strategy do they have? Okay, Shopify sits in front of a multi-trillion-dollar addressable market, and the stock is trading at a bargain compared to historical valuations. Okay, this growth stock is brimming with potential. Investors have a rare opportunity to buy at a bargain price. Investor sentiment has soured in response to high inflation and rising interest rates, causing the stock market to crater. The S&P 500 and the Nasdaq Composite have declined for three consecutive quarters, something that last happened in 2009, and both indexes have dipped into bear market territory. The dominant effect has erased trillions of dollars in wealth. The dominant effect has erased trillions of dollars in wealth, but it has also created rare buying opportunities. Shopify is a perfect example. The Canadian company, oh, it was a Canadian company, okay, is rapidly becoming a cornerstone of the e-commerce industry, and management is executing on a growth strategy that could create tremendous value for shareholders in the coming years. Yeah, Shopify has seen its share price plunge 76%, making its greatest loss of value any point since its IPO in 2015. Okay. That puts investors in front of a once in a generation buying opportunity. Disrupting the e-commerce industry. The Amazon marketplace played a significant role in popularizing e-commerce over the last 2 decades. But brands are increasingly interested in a direct-to-customer sales strategy, simply because it gives them a better shot at building lasting relationships with buyers. Shopify blends all of that functionality into an omni-channel interface. Its software integrates with popular marketplaces and social media platforms, but it also supports D2C websites and brick and mortar stores. Shopify also provides a number of adjacent services, including payment processing, financing, and cross-border commerce tools. Merchants can also access thousands of integrations through the Shopify App Store, such as payroll and marketing software. In short, Shopify lets merchants manage physical and digital sales from a single platform while providing value added services that drive growth. The value proposition has resulted in strong demand. According to G2 Greed, Shopify is the market leader in e-commerce software. Better yet, its platform accounted for 10.3% of online retail sales in the US 10 last year, making it the second largest domestic e-commerce company. That bodes well for the future. According to eMarketer, online retail sales in the US will grow at 12% annually to reach $1.7 trillion by 2026. I think for real, this is something that people would definitely need because for a retail seller, this is like the must go destination. Because in order for a retail seller to sell their products well, they've got to use internet, or like they have to use some kind of program to sell their product, right? And internet is the most efficient way uh, for sellers. And Shopify um, helps sellers to uh, do that well. So okay, let's read this again. Management has set an ambitious growth strategy that could eventually transform Shopify into a $1 trillion company. Here's a look at its parts. Shopify Fulfillment Network. At the SFN is an ecosystem of warehouses, carriers, and last mile delivery partners that simplify logistics across three critical phases of the supply chain: freight, distribution, and delivery. Ecosystem of warehouses, carriers, and last mile delivery partners that simplify logistics across three critical phases of the supply chain: freight, distribution, and delivery. First, shipping specialist Flexport will help merchants inbound freight more quickly and cost efficiently by allowing them to ship items at the pallet level. Second, the inventory will be routed through Shopify operated distribution hubs, where artificial intelligence software predict buyer demand and inform allocation decisions across smaller fulfillment centers. Third, collaborative mobile robots will help fulfillment workers pick, package, and ship products when merchants receive orders. A scaled SFN will support two-day delivery across the US that could boost conversion rate by more than 30% for some merchants, according to Shopify President Harley Frankstein. Okay. Management expects the SFN to reach scale in late 2023 or early 2024. But Shopify has already reported strong momentum. In the third quarter, the number of merchants using at least one logistics service increased 80% on a sequential basis, and fulfilled orders soared 450% from the prior year. Larger brands tend to be more profitable, so Shopify is pushing up market with Shopify Push, a more customizable version of its commerce platform. Shopify recently debuted AI-powered marketing software for Plus merchants. It added more robust business commerce tools for the platform. So they have a fulfillment network, which helps Shopify users to um, do logistics work. And Shopify Plus is a AI marketing tool that Shopify users can use. Merchants using the marketing software have already seen an uptick in conversion, but the B2B tools have even bigger implications. First, management estimate over half of existing Plus merchants could utilize B2B tools. Second, B2B capabilities should bring more brands to Shopify Plus. Third, Shopify now has a much larger addressable market. Hmm. According to eMarketer, B2B e-commerce sales in the US alone will grow at 10% annually to reach 2.5 trillion by 2026. Geographic expansion. So, what I said earlier uh, was Shopify uh, fulfillment network. And next one was Shopify Plus AI marketing tool. And the third one is geographical expansion. Offers localized subscription plans in over 200 countries. And you continue to bring adjacent services to new markets in the third quarter. Shopify now offers payment processing in 22 countries. It provides financing in 4 countries, and its point of sale platform is available in 14 countries. In short, Shopify has extended its purview well beyond North America, expanding its market opportunity. According to current forecast, retail e-commerce sales will grow at 10% annually to reach 7.4 trillion worldwide by 2025, while global B2B e-commerce sales will grow at nearly 20% annually to reach $33 trillion by 2030. Okay. Trading at the bargain price. Economic uncertainty has been a headwind for Shopify. And growth has slowed as high inflation has stifled consumer spending, but management has continued to invest in product innovation and geographic expansion. The combination has led to underwhelming financial results this year, causing some investors lose confidence. But economic headwinds are temporary, and management's growth strategy makes the bull case crystal clear. Shopify is the market leader in e-commerce software. Mm. Its ability to simplify sales across physical and digital channels while empowering merchants with D2C and B2B capabilities distinguishes it from a commerce giants like Amazon. That leaves Shopify well positioned to take a share in multi-trillion-dollar market today. And while its market cap currently sits at $50 billion, if things go just right for Shopify, a $1 trillion valuation is plausible a decade or two down the road. Currently, shares of Shopify trade at 9.78 times sales, a bargain compared to the 5-year average of a 29.7 times sales. That's why this growth stock is worth buying today. I totally agree, Shopify. Kathy will win bargain shopping. 3 stocks to be she bought hand or fist so far in November. Roku again. Okay, let's read this. While other investors have left Roku for that, Wood has been buying the streaming specialist stock like there's no tomorrow, adding more than 250,000 shares to her various ETFs over the past 2 weeks alone. Okay. Roku's third quarter results earlier this month were a mixed bag. Roku. Mm-hmm. The company added 2.3 million active accounts, bringing the total to 65.4 million, up 16%, while streaming hours climbed to 21.9 billion. But there are a couple of catalysts that could turn Roku's fortunes around. Netflix recently introduced its ad-supported streaming tier, and Disney Plus will be following suit within weeks. This will no doubt bring new viewers into the fold, which will be a win for Roku, which makes the lion's share of its revenue from the advertising that appears on its platform. Furthermore, supply constraints that have limited supply of connected TV should be easing, which should energize Roku's viewer growth. Hmm. Why do you have to buy Roku? I cannot just say it right away, so let's just Google it, okay? Why do you have to buy Roku? has been absolutely obliterated over the past 15 months, dealing with higher input costs and a weaker digital ad market. Higher input cost, the company has a leading market share and a long runway for growth. So let's read this carefully, okay? This might take a couple of minutes or so, but then it's really important. So I'm gonna read this, and I'm gonna read a article about Twilio, and then we'll go over to marketbeat.com. We'll briefly go over the articles, but then we'll talk about the questions that I talked about earlier. Okay. Mm. Favorable long-term characteristics might outweigh any near-term headwinds. The Roku increased revenue and gross profit by 593%. Wow. And 1,064% respectively. They are facing headwinds, sizable opportunity. What sizable opportunity do they have? Let's read. It's not all negative news. Roku currently holds the top spot in market share from smart TV operating systems. Hold a top spot in the market share for smart TV operating systems, okay? In North America at 41%. Okay. Smart TV operating systems in North America at 41%. 41%. Top spot. Smart TV operating system, okay? That's a powerful position to be in today. And those 63.1 million active accounts streamed 20.7 billion hours of content during the second quarter, which was up 19% compared to the prior year period. Okay. 41% North America smart TV operation and streamed the 20.7 billion hours of content during the second quarter, which is up 19% compared to prior year. Okay. Valid argument can be made that streaming on Roku's platform could increase even more in a recessionary environment as consumers cut back on spending and stay at home more often. And during this recession, people would stay at home and they would cut back on their spending. So they likely to spend their time watching new kind of series from Roku, right? Mm. Roku provides obvious value to its stakeholders. Consumers can view all of their streaming services on one simple and easy to use interface. Okay, it's easy to use interface. Okay, content companies such as Netflix and Walt Disney can reach a broad audience, and business that want to advertise can use Roku's platform to do so. So in Roku's platform, Netflix and other companies like Walt Disney are in it. Okay. Mm. It's a three-sided ecosystem where all parties benefit. Three-sided ecosystem. Okay, it's three-sided where all parties benefit. Okay, all parties benefit. So it's not like they're in like competition. Like all of them benefit. So which makes them more attractive because they're not like competing against other companies. If other companies use that user ecosystem, both can have both can gain get benefits. So why would they not use it, right? So can reach a broad audience, and business that want to advertise can use Roku's platform to do so. It's three-sided ecosystem where all parties benefit. In addition to being the clear leader in the industry today, Roku still has a big opportunity to continue growing the years ahead. According to a statistic, okay, there's a statistic. There are 1.3 billion broadband households worldwide and 110 million in the US, meaning lots of untapped potential for Roku to have a presence in more living rooms across the globe. Okay, there are like 1.3 billion broadband households. There are like 1.3 billion households worldwide. So they got a lot of potential. Um, let's let's repeat again. They're like 40.1 share. Um, they like having a top spot. North America. Mm, smart TV ecosystem. It's not like they're competing against other companies. If they use, if Netflix and like Walt Disney or in their system, all of them gain benefit. So it's really good, and they're like untapped market. Um, so they got a lot of opportunities. Okay. And according to the company, 50% of TV viewing time is devoted to streaming, whereas only 22% of advertising budgets are dedicated to it. As more dollars transition from linear TV to connected TV, Roku should benefit tremendously. It's a strong competitive position and a meaningful growth runaway are good reasons to like the business. And with the shares down 77% in 2022, Roku stock is now trading close to its lowest price sales uh, multiple ever. Investors should consider buying shares today. Let's read this really fast, okay? How does Roku work? Is it understandable? That's really important, okay? Roku makes it easy and affordable to watch your favorite TV. Roku devices act as the home for all of your entertainment. So you can streamline your setup, replace your expensive cable equipment, and watch what you love, all while saving money. Have you ever watched a YouTube video on your smartphone or Netflix movie on your laptop? That's streaming. Okay. It's the way video and audio content is delivered over the internet and has become a popular way to watch TV. Mm. Like, we use a cell phone to watch YouTube, um, or Netflix on our laptop. Everything is delivered over the internet, right? Delivered over the internet. That's streaming, because streaming lets you watch what you want the moment you want to. You don't have to wait for a download to finish your DVR to record or the show to come on the air. Yeah, that's right. You don't have to wait for a download to finish. The fun and convenience big screen TV, the choice of what to watch and what to pay for is up to you. We like to call it TV on your terms. You don't have to wait for a download to finish, or like you don't have to wait for a new show, right? You don't have to wait for the show to come on the air. Hmm. Streaming is an easy way to save money while enjoying your favorite TV. Whether you're saving on equipment fees by replacing a cable box with a streaming player or cutting cable altogether, you can still watch what you love. Roku devices provide easy access to free TV, news, sports, movies, and more. So you can be confident that you won't miss a thing. They provide reasonably priced device. They can help you watch TV freely. They can help you watch uh, with cheaper price. Mm. Stream top free or paid programming from services like Netflix, Prime Video, Hulu, Apple TV, HBO Max, Showtime, Pluto TV, and the Roku channel. Thousands more channels for sports, news, international, and keys programming, plus broadcast channels like ABC, and major music services like Pandora, Spotify. Videos are available. So all the things they can imagine are all in Roku. And by using Roku, you can watch what you want uh, whenever you want to, and you can watch what you want um, with your taste. Oh. You don't have to wait for download to finish. You don't have to wait for um, show on the air. You can pick what you want from various channels that you cannot possibly imagine. So okay, I've spent too much time. It's already 12:10, so I'm just gonna go to bed right now. Okay, I'm gonna see you tomorrow. Okay, bye bye.